Welcome back to the channel, guys. Johan Lorenzo here, and today I want to bring you 3 dividend-paying stocks that I will be buying throughout all of 2022. If you've been following the channel, you will know that a little over a month ago, I sold all of my dividend stocks in my public portfolio, and I used that money in my options trading account to trade options on high growth stocks like Tesla and AMD. The time has come. I'm getting itchy. I'm going to use a lot of that profit to start building this dividend portfolio once and for all again. This public account that I'm going to build now, I'm not planning on selling it ever again. Let this be a timestamp. So with these 3 stocks, I'm going to start it off. Without further ado, let's get into the video. All right, so first things first. The first stock that I'm going to be investing in to kick off this new portfolio is going to be ticker symbol SCHD. This is the Charles Schwab US Equity ETF. At the moment, they have a total of 105 holdings, which basically means when you buy shares of this ETF, your money will be automatically diversified amongst 105 different companies. Not only is this a very passive, laid-back way of investing, but it works. And if you take a look here, these are their top 20 holdings, and they're pretty much diversified through the entire market. They have 22.4% in financials, 20.4% in tech. They have 14.4% in consumer staples, 13.5% industrials, 12.6% healthcare, 6.2% consumer discretionary, 5.1% communications, and 3.4% materials. And we have another sliver here of energy for 2%. Every time you buy a share of this ETF, your money is diversified across all these different sectors. If you're new to the stock market and you don't want to be on top of your portfolio and constantly researching and doing your homework, this is a pretty passive way to have your money work for you and be diversified amongst all these different companies. So going over to look at their dividend yield, right now, SCHD pays a dividend yield of 2.85%. And as you can see here on the right-hand side, they've been growing their dividend at a pretty fast rate, at 11% from 2020 to 2021. Their current share price right now is $78.85. They're down 1% for the day. And if you look at this little chart right here for their dividend growth throughout the years, remember, this company was formed in October 20th of 2011. That's when it was established. And it's out of the US, obviously. This dividend chart right here, their dividend growth, as you can see from when they started in 2011, they've consistently grown that dividend every year, which is a very good thing amongst dividend investors. You always want the dividend to grow so you could continue to get paid more and more money as the years pass. Not only does it help you with inflation, but it just gives you a pay raise, and we all love pay raises, right? If you own shares of this ETF, you will get paid in the months of March, July, September, and December. So every March, July, September, and December, you could expect a nice little juicy dividend from this ETF right here. So going over to Seeking Alpha, you look up SCHD, and as you can see, in the last year, they're up almost 21%. Year to date, they're down because the whole market's been down. Been a lot of volatility lately, but they're at a 2.45% discount right now, year to date. For the year, though, they're up 21%. I'm going to start dollar cost averaging into this ETF just to play it safe. I don't want to try to time the market. I already have enough of that by trading options. I'm just going to dollar cost average into this ETF and trust the process, because over the years, for many, many years now, nothing has made more millionaires than people who just automatically invest into a trustworthy ETF like this one. So as you can see, their 52-week range, they've had a low of 65.84 and they've had a high of 82.48. Right now, they're not at a huge discount. As you can see, they are still towards the top of this 52-week range right here. But I am still going to trust the process and just dollar cost average into this ETF right here and trust the process. That's the most important thing. Over the years, nothing has made more millionaires than people who just consistently dollar cost average into the market. Because when you dollar cost average into the market, not only do you catch the lows, but you catch the middle and the highs. And all of that will give you a pretty good average of the overall market. So the second one on this list is known as the world's most valuable brand, and that is none other than Apple. Ticker symbol AAPL. Taking a look at Seeking Alpha here, you can see Apple is up 29% for the year, and year to date, They're currently down 2.6%. This stock has been on the up and up since as long as I can remember. That's why I'm going to start really loading up on these shares. Even though they don't pay a really big dividend, they still pay a dividend. And if you guys don't already know, I'm sure some of you have guessed, I am going to sell covered calls on this and basically generate my own dividend. Even though selling a covered call, you don't get all the tax benefits of regular dividends, but it is a form of cash flow and I will use that profit to buy more of this stock. But with all that said, in the last 10 years, the stock is up 953%. It's just constantly going up. Look at this chart for the max, the history of the company. It's incredible. So right now they're at a 2.6% discount. Their 52-week range, they have a low of $116 and a high of $182. Right now they're currently sitting at $172. It's not the biggest of discounts, but I'm going to do the same thing here. I'm going to start dollar cost averaging little by little and grabbing a couple shares at a time and work my way into these positions throughout the next couple months. Obviously, guys, we're still going to have a lot of volatility in the market coming up. I mean, the first interest hikes are going to happen in March. Even though I think the market's already ahead of it and it's priced in a lot of that stuff that's going to happen, I'm still going to dollar cost average just to be safe. I wouldn't want to throw all my money in there at once and then we have a major dip and I'm out of cash and I can't take advantage of the opportunity. So for this reason, I'm going to start dollar cost averaging into Apple as well. So taking a look at Simply Safe dividends, Apple obviously has a yield of 0.51%, a dividend safety score of 99%. Very good there. No worries on losing that dividend payment. They have a dividend growth rate of 7.3% average. So you are getting a pay raise of 7.3% every year right now. Their payout ratio is a very low, comfortable 14%. They have a forward payout ratio of 14% as well. They have a 9-year dividend streak. And as you can see, this dividend growth chart, this looks as good as possible. Look at this scale right here. From the moment they started paying a dividend, this thing has shot up and consistently scaled upwards. That's a really good thing for dividend investors. And guys, don't get discouraged because they pay a small dividend. I understand it's only 0.5%, but look at the bright side. What the company does in capital appreciation pretty much beats dividends in my opinion. Not only that, but if you do work your way up to 100 shares, you can sell covered calls and generate even more cash flow to boost that dividend. That's what I'm going to do. I understand it's not easy and it's pretty difficult to own 100 shares, 200 shares of a company, but you guys can work your way there just like I did. Nobody gave me this money. I worked my way there. So just buy a couple shares at a time, work your way up to 100. And once you do, the premium on these contracts are pretty nice. You could easily generate $100, $150 a week on selling an out of the money option on Apple. So if you own shares of Apple, you will get paid the months of May, August, November, and February. The stock right now has a pretty high PE ratio, and as you can see, Simply Safe Dividend is saying that the stock could be overvalued unless you believe the company's long-term outlook has strengthened, which I do. But for this reason is why I'm kind of going to tiptoe around it, and I'm just going to dollar cost average little by little and grab a couple shares at a time. So as you can see, their dividend yield here is pretty low, way below their 5-year average, to be honest, is way lower, as low as it's been ever. So it usually indicates that the stock is overvalued. When it hangs around the 5-year average, that's pretty much a fair price. But then again, guys, we have so much inflation going on right now that who is to judge this? Like, this might be completely off. This might be the new average due to inflation. I mean, nobody knows. I'm not going to try to time it. I'm just going to dollar cost average. Earnings payout ratio. The stock is doing amazing. The last 12 months and the trailing 12 month is at a 14%. Very comfortable payout ratio. Their free cash flow payout ratio is also very good. Obviously 14%. Their earnings per share, look at this scale. I mean, that's picture perfect. If scaling was in the dictionary, this is the picture you'd find right here. So in 2012, they had $1.58 earnings per share. The last 12 months, $6.22. Boom, I'll take it. Free cash flow, same thing. Scaling upwards, baby. That's what you want to look for. Take a look at from 2012 how the shares outstanding have been steadily decreasing. This is exactly what you want to see. Generally, how they say here, generally speaking, we prefer to see a declining share count. In 2012, they had $157 billion in sales. Less than 10 years later, they doubled. They more than doubled that. $378 billion in sales less than 10 years later. As you can see, their operating margin also looks good. Simply Safe Dividend basically states anything above 12% is their preference for most companies. Apple's sitting at a very comfortable 31% operating margin. Their free cash flow margin is also doing pretty well, as you can see. Anything above 5% is the preference for most companies. They're sitting at a pretty solid 22%. Can't complain here. And if you take a look at interest coverage, anything above 8% is the preference. The company's sitting at a super comfortable 43%. And this basically, as you can see here, divides the operating income by interest expenses to gauge how easily a firm can meet its interest obligations. If a company has significant debt, interest payments can consume most of its cash flow and potentially pressure the dividend. Apple, you have nothing to worry about here. This is more than comfortable. The third and final one on this list is a software giant that just recently reported a quarterly revenue of $51.7 billion. That's a 20% gain from last year's levels. And we're talking about the one and only Microsoft. Ticker symbol MSFT. The giant of them all, another member of the $1 trillion boys club, Microsoft. As you can see, in the past year, they're up 23.9%, 24% basically. Year to date right now, they're down 10.4%. So this was actually at a little bit of a better deal than anything else I've looked at, obviously. If you look at the 52-week range, they've had a low of $224 and a high of $349. At the moment, they're sitting at $301 a share. And if we take a look at the last several days, the stock's just been getting beat down. Their 5-day, they're down 2.2%. In a month, they're down 10%. And in the last 6 months, they're just up 4.9%. Year to date, they're down obviously because we're just in February. But over the year, they're up 24% still. In the last 5 years, 373% gain. Good Lord. That's something I want to be a part of. I don't know about you, but I definitely want to be a part of this. Okay. So let's take a look at Simply Safe Dividends again and check out Microsoft and break them down a little bit. All right. Same thing goes as Apple, right? They have a small dividend yield, 0.82%. Do not let this discourage you. Look at the capital gains that this stock makes. What my plan is, I plan on doing the same thing. Little by little, I'm going to start grabbing shares. I'm going to start dollar cost averaging into Microsoft. I'm going to work my way to 100 shares plus, and I'm going to sell out of the money call options on this so I can boost this dividend payment right here. If I can generate an extra $80 a week on Microsoft selling out of the money call options, I'll take it. That's $160 bi-weekly. I'll take it, guys. $320 a month plus the dividend yield, I'll take it. As you can see, Simply Safe Dividends gives them a dividend safety score of 99%. Nothing to worry about there. Their dividend growth rate is at 11% from September 21. Obviously, that's fast. Right now, they're sitting at $301.25. Their market cap is $2.2 trillion. And this is another thing here. With the market being as volatile as it is, I'm going to focus on Microsoft and Apple for this reason. A $2.2 trillion market cap company is not going to go bankrupt in a couple years. It's just not going to happen. I'm willing to bet every single penny to my name that this company will not be bankrupt in 10 years. So chances are this is going to continue to grow. Guys, $2.2 trillion. This is powerful. Okay. I might not agree with everything Bill Gates does, but this is powerful. But regardless, there's so many people involved in this company. It's headed in the right direction. They just acquired Activision, which makes a good amount of profit every year. I like where Microsoft is heading. They're going to increase their revenue yearly now with that new purchase. So we'll see where they land. Taking a look at their key metrics, once again, everything looks really nice. Their payout ratio is a very comfortable 27%. As you can see, very low for most companies. Their forward payout ratio is 25%. And right now they have an uninterrupted dividend streak of 15 years. So they've been growing that dividend for 11 out of the 15 years. And as you can see, looking at this little chart here of their dividend payments, from 2010, the dividend has consistently scaled upwards. If you own shares of Microsoft, you will receive dividend payments in the month of June, September, December, and March. So every June, September, December, and March, you will be receiving a nice little juicy payment from Microsoft. Not only are you going to get a ton of appreciation, most likely over the years, but you're also going to receive a nice little dividend. And if you work your way up to 100 shares, you sell covered calls out of the money and you generate even more cash flow on a consistent weekly basis. It's a win-win in my book, and that's where I'm going, guys. You guys are going to witness it. That's going to be the path I take with these stocks. Not only am I going to invest in other dividend companies, but these small dividend payers like Microsoft and Apple, I will be trading options on them on this account. And the money I generate through options, I will probably eventually just reinvest it back into the company as I will the dividends, just to compound that growth even faster and get that snowball going that much quicker. So if you take a look at their valuation right now, yes, it could look overvalued to a lot of people, and it probably is a little overvalued, even though it's taken a pretty good dip in the 52-week range. From the high of 343, it's down at 301 right now. But for this same reason, with inflation and everything else going on, I'm going to attack this the same way. I'm going to start dollar cost averaging, grabbing a couple shares at a time, building my position, grabbing some of the highs, definitely grabbing a lot of the lows. If it takes another major dip from here, I'm just going to add a bunch of money up front. I'll probably grab 30, 40 shares at a time if we get a big buying opportunity. But my goal right now is to start dollar cost averaging into this position. As you can see, once again, it'll tell you unless you believe the company's long-term outlook has strengthened. And I honestly do believe it has with Microsoft just purchasing Activision. They are going to be the head honcho of the gaming industry. Guys, it's a fact. Microsoft is going to own the top games that are played online for gamers. Not only that, but the Activision deal is going to give them an extra $8 to $9 billion a year in revenue. I'll take it for what it is. Taking a look at their earnings payout ratio, I mean, look at this right here. The last 12 months, 25%. What more stability do you want than that? Free cash flow payout ratio, same thing, 29% the last month. Simply Safe Dividend suggests below 60% is their preference for most companies. Microsoft, 29%, I'll take it. Earnings per share, look at this scale right here. Look how well this has scaled, how nicely this thing scaled. From 2012 all the way to now, 2022, this is obviously throughout 2021, this has gone from $2.78 per share to $9.87 per share. Good Lord. Free cash flow per share, same scenario, steadily increasing over the years. Last 12 months, $8.07 free cash flow per share. Another little cherry on top right here, their shares outstanding, steadily decreasing over the years. And I guess you could just throw another cherry next to the previous one. Their total sales have been consistently increasing year over year since 2012 as well, as you can see on this chart. In 2012, their total sales were $73.7 billion, and in the last 12 months, 185 bills. That's a big difference right there. Taking a look at the operating margin, sitting at a very nice 43% in the last 12 months. And once again, guys, a higher, more stable operating margins can be a sign of an advantaged business. Microsoft definitely has that going for them. Their free cash flow margin is also sitting nice at a comfortable 26% in the last 12 months. And if you take a peek at their interest coverage, taking a look down here, above 8% is their preference for most companies. This is the little safety gauge that Simply Safe Dividends has. And as you can see, Microsoft is sitting at 35.21. So that is good as well. Once again, taking a quick little peek at Seeking Alpha, if you look at their day range, they traded from $299 all the way to $311. So they're at 301 right now. My plan is by next week, start building this portfolio, grab a couple shares no matter where they're sitting. Start building this portfolio little by little and grabbing shares of Microsoft, Apple, and Charles Schwab ETF. As always, I want to thank you guys for watching. And if you enjoyed this content, please give this video a big thumbs up and subscribe to the channel if you haven't done so already. With all that said, until next time, peace!